In 1999, a company called Pets.com raised $82 million to sell dog food on the internet. They had a Super Bowl ad, they had a sock puppet mascot, they had everything except a business model. 11 months after their IPO, they were dead. Now here's the uncomfortable question nobody in Silicon Valley wants you to ask. How many AI companies right now are just Pets.com with a chatbot? Stay with me because I'm about to walk you through 5 warning signs that this AI gold rush might be running on fumes. And sign number 4 is the one that should genuinely concern you. Let's get something straight. I'm not here to tell you AI is fake. AI is real. The technology works. But here's the critical distinction most people miss. A real technology and a real investment opportunity are 2 completely different things. The internet was real in 1999 too. It changed the world exactly the way people predicted. And investors still lost trillions betting on it at the wrong time, at the wrong valuations, on the wrong companies. Right now, money is flooding into anything with AI stamped on it. Startups that would have been laughed out of pitch meetings 2 years ago are pulling in hundreds of millions. Public companies are adding AI to their earnings calls like a magic spell, and their stock prices jump overnight. Entire venture capital funds have been raised with a single thesis: put money into AI and figure out the details later. We have all seen this playbook before. The assets change, but the psychology doesn't. Every single time, the crowd says, no, this time is different, and every single time, it isn't. So let's look at the actual evidence. No hype, no doom, just 5 clear, observable patterns that historically signal a bubble approaching its limit. The first sign is the most measurable, and it's the one Wall Street analysts keep awkwardly dancing around. AI company valuations have completely decoupled from revenue. Look at the numbers. There are AI startups right now valued at 100, 200, in some cases over 300 times their annual revenue. To put that in perspective, during the dot-com peak, the average overvalued tech company traded at roughly 30 to 40 times revenue. We are operating at multiples that make the dot-com era look conservative. And it's not just startups. Major public companies have added hundreds of billions in market cap based on AI promises alone. Not delivered products, not proven margins, promises. Earnings calls have turned into AI keyword competitions. One analysis found that mentions of artificial intelligence in S&P 500 earnings calls increased over 400% between early 2023 and late 2025. Every time a CEO says the letters AI, the stock ticks up. That's not investing. That's a Pavlovian response. The counter-argument is always, but the total addressable market is enormous. Sure, the total addressable market for flying cars is enormous too. That doesn't mean you should value a flying car company at $1 trillion before they've sold a single unit. Now, before we hit sign 2, I need you to do something. Look at your own portfolio, your watch list, whatever you track. And ask yourself honestly, do I own anything right now purely because of AI hype? Hold that thought. Sign 2 is about where the real money is going, and it reveals something deeply uncomfortable. The companies making the most money from AI right now aren't the ones using it. They're the ones selling the tools. In a gold rush, the people who reliably get rich are the ones selling shovels. Right now, the shovels are GPUs, cloud computing, and data infrastructure. NVIDIA's revenue has exploded. Cloud providers are expanding data centers at a pace that would have seemed reckless 5 years ago. The total capital expenditure on AI infrastructure across major tech firms surpassed $200 billion in 2025 alone. Here's the problem. Someone has to generate a return on that $200 billion. For these investments to make sense, the companies buying all this compute need to create products that customers will actually pay for at scale. And right now, the revenue coming back in is a fraction of what's being spent. We're watching an enormous bet being placed, and the returns haven't arrived yet. It's like building a 1,000-room hotel in a town that gets 50 tourists a year. The building is real, the rooms are real, but the demand to fill them? That's still theoretical. This is exactly how overinvestment cycles work. The suppliers boom first, then everyone waits for the demand to catch up. And when it doesn't catch up fast enough, the entire chain corrects. Hard. The GPU shortage everyone panicked about a year ago? Don't be surprised if it turns into a GPU surplus faster than anyone expects. Here's a thought experiment. If every major company is spending billions on AI infrastructure and they're all building roughly the same type of products, who exactly is the customer? They can't all sell AI to each other. Someone has to be the end buyer. This brings us to sign 3, and this one is rampant. Thousands of companies now describe themselves as AI companies when what they actually built is a thin interface on top of someone else's model. The industry calls them wrappers. They take an existing large language model, add a login page and a slightly customized prompt, maybe a logo with a gradient on it, and call themselves an AI platform. Some of these have raised tens of millions of dollars. The barrier to entry is essentially zero. Anyone with a credit card and an API key can build a competitor over a weekend. When the barrier to entry is that low, margins collapse. It's inevitable. The moment the underlying model providers adjust their pricing or release their own consumer products, or a free open source alternative gets good enough, these wrapper companies evaporate. They have no moat, no proprietary technology, no defensible position. They have a billing page and a prompt template. This isn't speculation, it's already happening. The graveyard of dead AI startups is growing every quarter. Most of them launched after 2023, raised money on a pitch deck with the word revolutionary in it, and quietly shut down 18 months later when they couldn't retain users who had cheaper or free alternatives. By the way, if you're finding this useful, hit subscribe. I don't say that to be annoying. I say it because the algorithm actually buries videos like this that don't generate engagement, and I'd rather keep making them. Sign 4 is the one I mentioned at the top, the one that should genuinely concern you. It's happening quietly, and almost nobody is talking about it. AI companies are in an arms race for talent. Engineers, researchers, anyone with machine learning experience is being offered compensation packages that are staggering. We're talking total packages in the millions for individual contributors. Not executives, not co-founders, engineers. Some of these people are being recruited out of PhD programs with signing bonuses larger than what most people will earn in a decade. And the companies doing the recruiting? Half of them don't have a shipped product yet. On the surface, that sounds like a booming industry, but look deeper. When companies spend that aggressively on talent, their burn rates skyrocket, and many of these companies aren't generating meaningful revenue yet. They're spending venture capital and investor money to hoard people, not because they have immediate work that justifies the cost, but because they're terrified of a competitor hiring them first. This is a classic late cycle behavior. It happened in the dot-com era. It happened in crypto. Companies start hiring not based on need, but based on fear. The payroll balloons, the runway shortens, and when funding dries up, which it always does once sentiment shifts, you get mass layoffs almost overnight. Some of these corrections have already begun, but they've been framed as efficiency optimizations and strategic realignments. Those are bubble speak for, we overhired and the money is running out. The fifth and final sign is perhaps the most damning, and it's the hardest to quantify because it's about story versus substance. Right now, the dominant narrative around AI is that it will fundamentally transform every industry, every job, every aspect of human life, and that this transformation is imminent, not in 20 years, now. But when you actually survey businesses adopting AI tools, a very different picture emerges. Most enterprise deployments are still experimental. Integration costs are high. Reliability issues persist. The gap between the demo and the deployed product is enormous. AI demos are astonishing. I won't deny that. But demos are controlled environments. Real-world deployment means edge cases, compliance requirements, legacy system integration, user training, and 100 other friction points that don't show up in a keynote presentation. Talk to any enterprise CTO off the record and they'll tell you the same thing. The pilot went great, the rollout is a nightmare. The AI hallucinates at the worst moments. It breaks in ways that are hard to predict and expensive to fix. The story being told to investors is 5 to 10 years ahead of the product being delivered to customers. And when narratives get that far ahead of reality, the correction isn't gentle, it's violent. So where does all of this leave us? Let me be precise. I am not saying AI is going away. I am saying the market around AI is behaving irrationally, and history punishes irrational markets without exception. The technology will survive. Many of the companies currently riding the wave will not. The ones that survive will be the ones solving real problems for real customers at prices those customers are willing to pay. That's boring. It's also how every lasting tech company in history was built. If you're building with AI, build something defensible. If you're investing in AI, invest in fundamentals, not narratives. And if you're watching from the sidelines wondering whether you missed the boat, you might be arriving just in time to watch it sink, and that's not the worst position to be in. If this video made you think, subscribe and turn on notifications because I'm releasing a follow-up next week breaking down which AI companies actually have the fundamentals to survive the correction, and which ones are pets.com with a chatbot. I'll see you in that one.